An ordinary child born in Omaha, Nebraska in 1930 is today one of the world's richest people. Warren Buffett's fortune exceeds $100 billion. But his story isn't like other get-rich-quick tales. This is the story of an empire built patiently over 90 years. August 30, 1930. While America was in the grip of the Great Depression, Warren Edward Buffett was born in Omaha. His father, Howard Buffett, was a small stockbroker. His mother, Layla, was a housewife. He was the second child of a middle-class American family, but this child wasn't like the others. At age 6, he began memorizing numbers. Baseball player statistics, company profit-loss statements. He could keep everything in his head. While his friends played ball, he played with numbers. His first entrepreneurial experience began at age 6. He bought 6 bottles of Coca-Cola from his grandmother Rose's stall for 25 cents and sold each for 5 cents. A daily profit of 5 cents. In today's money, a few dollars. But for Warren, this wasn't about the amount, it was about the system. It was the first application of the buy low, sell high principle. At age 8, he began borrowing finance books from the library. He knew the book 1,000 Ways to Make 1,000 by heart. While his friends read comic books, he read Forbes magazine. This wasn't just a hobby. It was a passion. At age 11, he went to the stock exchange with his father. The day he bought his first stock, City's Service preferred stock, 3 shares at $38, total $114. This was about half of his father Howard's salary. The stock price began to fall. It dropped to $27. Warren panicked. This was the first time he'd experienced something like this. He spent nights in bed constantly thinking about the stock price. This early trauma would later make him a much more patient investor. When the price rose to $40, he immediately sold. He made a $5 profit, but a few weeks later, the stock rose to $200. This taught Warren the most important lesson of his life. Be patient. Buy good companies when they're very cheap and hold them for a long time. At age 14, he earned his first taxable income. By finding and cleaning golf balls, delivering newspapers, he directed all his earnings toward investment. He didn't make luxury purchases. His goal was growing. In 1945, at age 15, he bought 40 acres of land in Omaha. The price was $200. He rented this to a farmer. This was the beginning of his real estate investments. While still a high school student, he had become a real estate investor. During high school, he was always first in mathematics and economics classes. But his real education was happening outside school. He read many books every day. Benjamin Graham's Security Analysis book had become his Bible. When he graduated high school at age 18, his fortune was $9,800. In today's money, approximately $100,000. While most children spent money on toys, Warren was saving for the future. His father suggested he study at Harvard Business School. Warren applied but was rejected. This would be the best thing in his life, because this way he would discover Columbia University, and there he would meet Benjamin Graham. In 1949, Warren was accepted to Columbia University Business School. The reason was simple. Benjamin Graham taught there. Graham was the author of The Intelligent Investor. Warren had read this book, and his investment philosophy had completely changed. Graham's value investing approach was revolutionary. Buying companies at prices much cheaper than their real values. Not getting caught up in market emotions. Thinking long-term. These principles became Warren's life philosophy. His 2 years at Columbia shaped Warren's life. He was the only student to receive an A+ in Graham's classes. While other students struggled with theoretical questions, Warren analyzed real companies. His discovery of GEICO Insurance Company happened during this period. When he graduated in 1951, he asked Graham for a job. Graham said, "There are too many paid people on Wall Street, I can't hire you now." Warren was disappointed but didn't give up. He returned to Omaha and began working at his father's company. During this period, he continued to manage his own portfolio. Western Insurance Securities, Cleveland Worsted Mills, Genesee Valley Gas. He selected each using Graham's method. He tried to buy companies worth $1 for 50 cents. In 1954, Graham finally called him to New York. He started working as an analyst at Graham Newman Corporation. His salary was $12,000 annually, but the real value was knowledge. He was learning true value investing alongside Graham. During this period, his investment in GEICO was one of the turning points of his career. He analyzed the company thoroughly. It could sell policies 15% cheaper than its competitors. Warren invested 75% of all his money in GEICO. In 1956, Graham announced he would retire. He offered Warren, "Let's continue the partnership." But Warren made a different decision. He said he would return to Omaha. Graham was surprised. "Why?" "You'd be very successful in New York." Warren's answer was simple. "I want to develop my own method. I'll consider you my mentor, but I'll chart my own course." The 25-year-old young man had decided to leave his mentor behind and build his own empire. When he returned to Omaha, his fortune was $174,000. In today's money, $1.7 million. He was only 25 and very close to becoming a millionaire. But the real big step was coming next, the establishment of Buffett Partnership. May 1st. On 1956, Warren Buffett, at age 25, founded his own investment partnership. Buffett Associates Limited, his first investor, was his sister Doris. She gave $35,000. The total starting capital was $105,000. Warren's own contribution was only $100. This period was Warren's most creative. He developed his own method by improving on what Graham had taught. He was no longer just looking for cheap stocks. He bought wonderful companies at reasonable prices. He also began learning Philip Fisher's growth investing approach. His first big success came with Sanborn Map Company. The company made maps, but its real value was the securities it held. Warren bought 35% of the company and changed management. He made a 50% profit in 2 years. In 1957, his performance was incredible. While the market fell 8.4%, Buffett Partnership rose 10.4%. This couldn't be explained by luck alone. The system was working. In 1958, Warren married at a young age, with Susan Thompson. Even on their honeymoon, he was reading books. Susan understood and supported Warren's passion. "Warren dances with numbers," she would say. Warren's investment style was very distinctive. He analyzed companies thoroughly. He met with managers, visited their factories, studied their competitors. This wasn't just financial analysis, it was like detective work. His investment in Dempster Mill Manufacturing was the best example of this approach. The agricultural equipment manufacturer was selling at a loss. Warren bought controlling shares and made Harry Bottle the CEO. He saved the company in 2 years. In 1960, he restructured the partnership. It was now a single company called Buffett Partnership Limited. Warren was the general partner, others were limited partners. The profit-sharing system was very clever. The first 6% was shared by all partners, and Warren took 25% of the profit above that. During this period, Warren's lifestyle was very simple. He lived in a house he bought for $31,500 in Omaha. He didn't use a car, mostly walked. He devoted all his time to reading and analyzing. His 1961 investment in American Express was one of his smartest moves. After the Salad Oil scandal, the company's shares had crashed. Everyone thought American Express was finished. But Warren saw the potential of the company's credit card business. He sat in restaurants observing credit card usage. People continued using American Express cards. The scandal was temporary, but brand value was permanent. He made a 40% profit from this investment. In 1963, he began investing in Berkshire Hathaway. It was a textile company at the time and in trouble. Warren had bought it for its cheapness, but this mistake cost him dearly. The textile business lost money for 20 years, but Berkshire would be important because it would become Warren's holding company. By the end of 1965, the partnership's assets had reached $26 million. Warren's personal fortune was $6.8 million. He had become a millionaire at age 35, but he had much bigger plans. In 1966, he made the Forbes list for the first time. But what was really striking was his performance, an average annual return of 31.6% over 10 years. During the same period, the Dow Jones had risen only 7.4%. Warren wasn't just lucky, he was truly a genius. This success made Warren well known. Investors lined up to invest money with him, but Warren was selective. He only accepted investors who thought long-term. In 1967, he took control of Berkshire Hathaway. This move would change his life. He would now use the holding company model. The Buffett partnership period was coming to an end. Chapter 4. Berkshire Hathaway Transformation. In 1969, Warren Buffett made a shocking decision. He announced he would close Buffett Partnership. Why? He could no longer find cheap stocks in the market. A good hunter doesn't hunt when he can't find prey, he said. In 1970, the partnership officially closed. He offered investors two options: exit with cash or take Berkshire Hathaway shares. Most chose cash. This was the biggest mistake of their lives. Berkshire Hathaway's share was $39 in 1970. Today, it exceeds $500,000. Investors who trusted Warren at that time became millionaires. Warren was now playing a different game. He had made Berkshire a holding company. He bought shares of valuable companies and held them long-term, sometimes buying them completely. This strategy was very successful. In 1972, he bought See's Candies for $25 million. The company's net assets were $8 million. Warren paid $17 million for goodwill, i.e., brand value. This was the beginning of his pay premium for quality philosophy. The See's Candies acquisition changed Warren's thinking. He was now looking for quality companies, not just cheap ones. Wonderful companies at reasonable prices are better than mediocre companies at expensive prices, he said. The 1973-74 bear market was a great opportunity for Warren. While everyone was panicking, he was shopping. He began buying Washington Post shares. The company's market value was $80 million, but Warren thought its real value was $400 million. The Washington Post investment brought Warren something else: friendship with Katharine Graham. He became close friends with Graham, the newspaper's owner. Warren's social circle expansion began during this period. In 1976, GEICO went into crisis. The company Warren had invested in during his youth was on the verge of bankruptcy. Warren decided to save the company for both emotional and financial reasons. He made an additional investment of $19 million. The GEICO rescue operation was one of Warren's smartest moves. The company recovered in the 1980s and became one of Berkshire's most profitable investments. In 1996, he also bought the remaining shares and completely owned the company. During this period, Warren's lifestyle was still very simple. He lived in the same house, ate simple meals, used his old car. Wealth hadn't changed him. In 1977, Berkshire's share was $102. Warren was approaching becoming a billionaire, but nobody noticed. He was still the investor living a simple life in Omaha. In 1979, Fortune magazine published a major article about Warren. The nickname Oracle of Omaha began during this period. He was now known beyond Wall Street. By the early 1980s, Warren's portfolio strategy became clear: large investments in few companies, focusing on companies he knew very well. This approach is known as concentrated investing. This strategy was extremely successful. In 1980, Berkshire's share was $290. By 1990, it had risen to $7,275. It had increased 25 times in 10 years. Warren was now a billionaire. But the real big investments were yet to come. Coca-Cola, American Express, Apple. These would make Warren one of the world's richest people. 1988 was one of the turning points in Warren Buffett's career. The year he began investing in Coca-Cola. This wasn't just a stock purchase. It was the perfect example of Warren's investment philosophy. Why did he choose Coca-Cola? Because the company perfectly fit Warren's criteria. Strong brand, wide moat, predictable cash flow, worldwide growth potential. "I do businesses I can understand," Warren said. Between 1988 and 1994, he bought Coca-Cola shares worth a total of $1.3 billion. It constituted 40% of Berkshire's portfolio. Though it seemed very risky, Warren was confident. "Coca-Cola will still be drunk 100 years from now," he said. This investment became legendary in history. Coca-Cola shares increased 10 times in 10 years. Warren's $1.3 billion investment rose to $13 billion. Today, those shares are worth $25 billion. The success of the Coca-Cola investment gave Warren great confidence. He now focused more on brand value. See's Candies, Washington Post, Coca-Cola, they all had strong brands in common. In the 1990s, Warren's fame spread worldwide. Thousands of investors began coming to Berkshire Hathaway's annual meeting every year. Warren's letters became investment classics. During this period, Warren's life story also changed. In 1977, he began living separately from his wife Susan. But this wasn't an official divorce. They both remained friends. At Susan's suggestion, he began living with Astrid Menks. In 1996, he completely bought GEICO. He paid $2.3 billion. The company Warren had followed since his youth was now completely Berkshire's. "I fulfilled a dream," he said. During this period, another feature of Warren's emerged: philanthropy. In 1996, he and his wife Susan founded the Buffett Foundation. Plans to donate the majority of Warren's fortune to charity took shape during this period. In the early 2000s, the technology bubble burst. Warren had stayed away from technology stocks and was criticized. He was called old-fashioned, and it was said he didn't understand the internet age. But when the bubble burst, Warren was proven right. His philosophy of "I don't invest in businesses I don't understand" protected him. Berkshire suffered very little damage during this period. Warren's patient approach was once again validated. In 2006, Warren made a big decision. He announced he would donate 85% of his fortune to charity. Most of this would go to his friend Bill Gates' foundation. This was the largest philanthropic donation in history. He started the Giving Pledge campaign with Gates. He asked the world's richest people to promise to donate half their fortunes. More than 100 billionaires made this promise. Warren's understanding of philanthropy was very thoughtful. "I want to donate my money while I'm alive, so I can see its impact," he said. This approach influenced other wealthy people. During this period, Berkshire's portfolio became even more diversified. American Express, Wells Fargo, Procter & Gamble. Warren was no longer focusing on just a few stocks, but managing a broader portfolio. But the biggest surprise was yet to come. The Apple investment. 2016 was the beginning of a new era for Warren Buffett. At age 85, he made a decision that surprised everyone. He began buying Apple stock. Why had Warren, who said, "I don't invest in technology companies," changed his mind? The answer was simple. Apple was no longer a technology company, but a consumer brand. The iPhone wasn't just a phone, but a lifestyle people couldn't give up. Warren had seen this. Between 2016 and 2018, he invested $36 billion in Apple. It became Berkshire's largest position. This investment would be one of Warren's most profitable deals. The Apple investment showed Warren's evolution. Even approaching age 90, he continued learning new things. "I wake up every day to learn something new," he said. During this period, Warren's daily routine was very interesting. He woke up at 6:45 every morning and immediately read newspapers. Wall Street Journal, Financial Times, New York Times. He spent 5 hours reading. His office desk was very simple. No computer, no complex financial models. Just annual reports, newspapers, and a calculator. "I keep it simple," he said. His eating habits were also very basic. McDonald's for breakfast every morning, hamburger for lunch, steakhouse for dinner. "I have the taste buds of a 6-year-old, he said laughingly. When the 2020 COVID pandemic came, Warren was 90 years old. While markets collapsed, he went shopping again. His philosophy of "be greedy when others are fearful" worked once more. During this period, Warren's succession issue also began to be discussed. Greg Abel was designated as Berkshire's future CEO. Warren was now preparing to pass on his 50-year empire. In 2021, after 17 years of living together with Astrid Menks following his wife Susan, he married. He started a new life at age 91. "Age is just a number," he said. Warren's philanthropy also increased in the modern period. He donates billions of dollars every year. He has donated $50 billion so far. 99% of his remaining fortune after death will also go to charity. The Berkshire Hathaway letter to shareholders are still the most important documents in the investment world. Warren still writes a 50,000-word report annually, even at age 90. Berkshire today is one of the world's largest companies. $800 billion market value, 400,000 employees, owner of more than 60 companies, The result of Warren's 60 years of labor. Today, Warren's fortune is $118 billion. He's the world's fifth richest person. But he still lives in the house he bought in 1958. He still lives simply. Wealth never changed him. The Apple investment was also a tremendous success. The $36 billion investment is now worth $150 billion. One of Warren's last great investment victories. Warren Buffett is 94 years old today. He still works every day, still invests, still continues learning. This is the greatest example of the patient investor. Warren Buffett's story isn't just about getting rich. This is a life lesson showing the power of patience, discipline, and ethical values. The secrets of his success are simple but difficult to apply. 1. Thinking. Long-term. Warren never bought a stock for short-term profit. He invested in companies he planned to hold for at least 10 years. 2. Focusing on businesses. You understand, he stayed within his circle of competence. He didn't invest in sectors he didn't understand. 3. Creating value. He didn't just focus on making money. He chose companies that would create value for society. For living simply, wealth didn't change him. He still lives in the same house, eats simple meals. 5. Continuous learning. Even at 94, he devotes 5 to 6 hours daily to reading, continues learning new things. 6. Learning from mistakes. Buying Berkshire Hathaway as a textile company was a big mistake. But he learned from this mistake and switched to the holding company model. 7. Choosing good partners. Charlie Munger has been his partner for 60 years. If you don't have a good partner, work alone, he says. Warren's most important message is this: wealth doesn't come overnight. This is the result of 60 years of patient work. The miracle of compound interest is real, but time is needed for this. His story proves that get-rich-quick stories are mostly deceptive. Real wealth comes with patience, discipline, and ethical values. Warren Buffett's formula is simple but powerful. Buy good companies at reasonable prices, hold them long-term, be patient. He has remained loyal to this formula for 90 years. The result? Becoming the world's most respected investor. Today, Warren still works in the same office in Omaha. He still teaches his students. Risk comes from not knowing what you're doing. Know good companies, be patient, don't panic. Warren Buffett's story isn't just financial success. This is a guide on how life should be lived. Simplicity, honesty, patience, and adding value to others. This is the secret of real wealth. This was an inspiring financial story from FinArch. From ordinary child to billionaire, Warren Buffett's 90-year journey of patience and discipline.